In the Money is made possible by financial support from Old National Bank and Chicagoans like you. Thank you.
Hello, welcome to In the Money. I'm your host, Kimberly Loftis, a CPA and financial executive who today is financially secure, but was not always. Coming out of college, I had a lot of credit card debt. It was spread across multiple lenders. Some balances were small and others were large. Some credit cards had high interest rates and others had low interest rates. I didn't know where to start. And then on top of all of that, I wasn't feeling so great because I was so ashamed that I got myself in such a bad situation. I was lost. What should I focus on first? I knew from using the 50-30-20 budgeting rule how much to set aside for paying down debt, but nothing more. I then researched ways to pay off debt and chose the one that satisfied my need to pay off debt the fastest. So I successfully went from opening multiple credit cards as a college student to get a free t-shirt and running them up, to paying off debt and using credit cards responsibly by using financial tools in my arsenal. In this case, it was the 50-30-20 rule we talked about in a previous episode, in case you missed it, and a debt demolition plan, which we will talk about today. I want you to be just as successful, if not even more too. Today in the living room, we're going to break down ways to either pay down the debt you have or avoid it in the first place. Tamara Dervin is the founder of Money Basics, an organization that focuses on financial education. Welcome to the show, Tamara.
Thank you for having me, Kimberly.
So I want to talk about debt. So with debt, there's different payment strategies. What are some that you would recommend?
Well, there are two payment strategies that are fairly popular. Mm-hmm. The first strategy is the debt snowball method, mm-hmm. where you would pay off the smallest balance to the largest balance. Mm-hmm. And then the second strategy is the avalanche method, where you would pay off the highest interest rate debt that you have to the lowest interest rate debt. And those are the two most popular methods. I will say that with the debt snowball method, it gives people quick wins. Mm-hmm. So it's a great strategy if psychologically you know that debt has been a burden and you really need something to give you a quick win to keep you going in the debt payment struggle, because mm-hmm. I call it, a lot of times it's a struggle. However, if you're a savvy person and you're saying, okay, I want to get out of debt, I don't want to pay all this high interest, especially in this current interest rate environment, mm-hmm. the strategy for you would probably be the avalanche method, where you would get rid of that high interest credit card or debt first, and then go down to your lowest interest rate debt.
So if I compare the two under the snowball and the avalanche, if I wanted to, overall, if I pay off my debt over the same period of time, the avalanche method will be paid off faster because you have lower interest because you're paying off the high interest.
Right.
So if you care about the total dollar value that you're paying,
you would want to go with the avalanche. However, I always tell people you have to be real with yourself. What method is going to give you the success that you want? Mm-hmm. Some people are very disciplined and they say, okay, I really care about my finances and I don't want to pay all this high interest rate. I want it to go faster mm-hmm. as far as the interest accumulation. So they go with the avalanche method. But some people start off with the avalanche method and they see, okay, the debt payoff process feels like drudgery. Mm-hmm. And they end up stopping because they're like, I'm tired of paying. Because sometimes with the highest interest rate debt, it's often your largest balance. Okay. So it doesn't seem like you're making any headway, although that you are making headway. So sometimes having those smaller balances with the debt snowball method, it gives you those quick wins to keep you going in the process. But it does, like you said, it does take longer sometimes mm-hmm. because it takes a longer time to get to your largest balance, which it will take some time.
So what about, because when I think about those two debt methods, I think about credit cards. Yes. But what about car loans? Can you put that into that same thing if you want to pay that off faster?
Yes, you can definitely still put that into the same framework mm-hmm. when you map out your smallest balance to largest balance or your highest interest rate. A lot of times your car loan typically is not as high as a credit card rate. So when you put it into the debt snowball method, it won't be probably your highest. It would probably be maybe closer to your lowest if you're mixing it in with credit cards. Mm-hmm. So with the debt snowball, it may be your largest balance though. So it will still be toward the end of your payment structure that you put together. But you can definitely put that in there. The only debt that I wouldn't recommend putting into the snowball method or the avalanche method would be your home mortgage, because typically that's your biggest debt.
Now, with car loans, isn't the interest rate, even if you pay it off early, so don't you still have to pay that interest because it's like a fixed loan? Is that the case for most car
Right, but
loans?
if you pay off, really the fixed rate is computed on what your balance is. So if you start throwing, like with the debt snowball method, you throw extra payments at it. So as you throw those larger payments at it, the amount of interest that you're paying toward that will go down, because the balance that it's computing it against will start to go down. So you'll end up over the life of the loan, if you put in extra payments, you will end up paying less interest than when you originally signed the contract.
Okay, so what happens if I start off with the one that's the avalanche method, and then I'm like, oh my God, is it bad that now I'm going to switch to the other method?
This is my thing. No theory is bad. The whole goal is for you to successfully demolish your debt. So if you start one method and you say, okay, I really want to switch, my recommendation would be to do that, because my ultimate goal for the people that I work with is for them to have success and at the end of the day say, I am debt free.
Okay.
So changing, the end of the day, is what the ultimate goal is success. So if you have to change, yes, there might be a shift in like how much interest you pay, but the ultimate goal is success.
And are there any other methods or tips you would give around picking a method or mixing the methods of paying down debt?
So I don't have an additional thing, but I will say, I think this show is going to be airing at the perfect time. It's tax time. So a tip would be that those that are doing their taxes and you know that you're getting possibly a tax refund, and you know that right now one of your financial goals for 2023 is to get rid of your debt, I would highly recommend that you maximize that tax refund and put it toward whatever method that you are leaning toward, whether it's the avalanche or the debt snowball method.
I love that tip. Now, moving on to avoiding debt. What would you recommend there?
My biggest thing, and you mentioned it in the intro about budgeting, one of the biggest ways that people get into the debt is that they don't actually budget and follow the budget that they set. So they typically overspend. They spend beyond what they actually have. And when you spend beyond your means, you create debt. So my biggest thing is create a budget and actually use tools to help you actually stick to your budget. And not only just stick to the budget, one of the ways to actually help you stick to the budget is to track your spending. A lot of times we don't track our spending, and there are a lot of online tools and applications to actually help you create the budget and also help you to actually track your spending, like track how much you're spending on gas, track how much you're spending on food. We know these costs are high right now. So if you're not tracking that, then you tend to not only overspend on your daily expenses, but then those things that you're looking to do, whether it's entertainment. We know a lot of different things are happening right now and they're high ticket items. So a lot of people tend to overspend on things thinking, okay, I have money, but they really haven't checked their budget and what they've already committed to do during that month. So I highly recommend doing that budgeting and tracking your spending so that you don't end up creating debt unnecessarily. Also, we have to be disciplined. We have to say, okay, in certain seasons, we have to say, okay, maybe I can't have that. I can't try to do the flashy things or buy the big things because that's beyond what I have right now, the capacity that I have right now financially. Because debt is, I tell people, it's easier to save for something than to get out of debt from something. So save for the things that you want to do, whether it's vacation, big ticket items that you want to purchase, save for them, allocate for them so that you don't create debt.
So how is that saving for these things you want to do, how is that different from an emergency fund?
So an emergency fund is really your foundation for when things happen. And we always know that something always happens. So we have to allocate for them. Even when you're doing your debt payoff process, I recommend having, even if it's a small emergency savings of $1,000 just to start, but having that cushion for when things happen that you can take care of them without derailing your debt payoff process. But emergencies, like I said, always happen, whether it's something with your car, your home, God forbid, a loss of a job or a loss of a spouse. Things happen where things shift in your finances that you need that cushion to help get you through. Now, when you're saving for something, let's say it's a vacation that you want to go on, you would allocate in your savings, okay, this is, and name it. People often don't, they'll just say, okay, I'm saving. No, name what you're saving for, because a lot of times when you name or have a purpose for why you're saving, it gives you psychologically that ammunition to make better decisions in your everyday spending so that you can reach that goal of what you're saving for. So if you're saving for a vacation, or, you know, everybody this year wants to go to the Beyonce concert. So if you want to save for those high price tickets, save for them in your monthly budget.
So you have a dollar amount that you're saving for your stuff, but what about an emergency fund? How would you set that?
So I would say that
size?
should be a regular, that should be one, if you don't have your emergency savings set, that should be your first priority, making sure that you do that. Create a budget based on, so your emergency fund should be about 6 to 8 months. I recommend, based on our current environment, 6 to 8 months of your expenses. You can evaluate what your household setup is, whether you're a single income household, dual income household, whether the job is stable or not. But 6 to 8 months can be comfortable of your expenses, and regularly save for that out of your monthly budget, whether you start to put $100, $200 toward that, and put that in a savings account. And I also recommend that you use the online high yield savings if you can.
Okay, perfect. These are wonderful tips for helping get out of debt and saving for the future. Thank you so much.
Thank you for having me, Kimberly.
Tune in this Friday at 7 p.m. on CAN TV 19 as I discuss caring for a parent and grandparent.
She may not have done everything I wanted her to do or been the nicest, right? But she showed love in so many other ways.
Yeah.
And so it's like I'm here right now, like, yeah, this is the least I can do.
We have learned from Tamara some effective ways to pay down debt and create an emergency fund. However, even though you have a debt plan, you can still feel ashamed or depressed. To help us understand this better, we are welcoming back to the living room Tamika Hill, a licensed clinical social worker, to help guide us on how to manage our feelings around having debt. Thanks for joining the conversation, Tamika.
Thank you. I'm so happy to be here.
So earlier, we were talking about ways to pay down debt. But also, even though I'm paying down debt, I feel bad, I feel ashamed, I don't want to talk to anyone about it. It's like my own private little horror story. What is going on with me?
A lot of times we feel guilt, right? When, especially when you're dealing with age, the maturity level. Like, say for instance, you're 40, you're like, I should be further along than this. So you don't talk about maybe the debt that you incurred over time because you're ashamed, but then the shame and depression and anxiety actually snowballs you to becoming more debt because you start spending emotionally. So a lot of people stay on the hamster wheel. I love what the previous guest said about, you know, pick avalanche or the snowball. The only thing I would say is you also got to know your personality, how to pay off debt. So if you know that you, like I think she said, immediate gratification, then you know to choose the faster one that's going to show that. But if you're, like she said, disciplined, then yeah, you would use that. But if you're a spender, that's not going to work.
So on an earlier episode of In the Money on the poverty mindset, you talked about those different mindsets around money. Can you kind of share with us what those big ones are that most people kind of fall into?
The compulsive spender, which that's of course the debt creator, and then you have your compulsive money makers. Those are usually, because they're polar opposites. Compulsive money makers trade their time for money, so you're usually not going to see them two in debt. What they're going to have is probably high stress. They're still dealing with depression and anxiety because they're constantly making money and not taking care of their mental health. Versus the debt person, they're dealing with a shame, guilt, anxiety, depression, and they kind of stay stuck there because they have to challenge their perspective.
So how do I overcome that to even know that I have that type of mindset where I need, instant or quick gratification and that I am a debt maker? Like, how do I even know that that's me? How do I recognize that in myself?
When ComEd and Night Court keep calling you. No, I'm just kidding. But you kind of know when you overspend. If you have the new layaway plan they have with the installment payments, and you have money coming out your paycheck every week, and you literally have zero left and probably still in the negative, you know you're a debt person.
Okay.
Like you buy things when you feel a certain way, whether it's happy, sad, depressed after a breakup, oh, I'm gonna go look good, or whatever's going on. I had a bad day at work, and you go to Walgreens because you want to buy 10 things for nothing, but you want to feel good. You know that you're an emotional spender.
So how do I stop being an emotional spender? What are some things I can do?
So with personalities, the funny thing about us as humans, we hard to change. So I don't always say try to overcome something. I say work with who you are till you can evolve who you want to be. So that means if you know you're an emotional spender, create a budget for it.
Okay.
So until you can get evolved to the next person or next level of life of what you want to be is more discipline. But if you're sitting here saying, oh, I'm going to all of a sudden stop spending emotionally, you're dreaming. Good luck. Because again, that creates that hamster wheel. We have to be honest and own who we are and not be ashamed of who we are, but create buffers to help us to evolve to be better with our finances.
Okay, so we kind of talked about ways to help us harness who we are to pick the best debt management strategy for us. But what do I do about that feeling of shame because I got myself in this situation? What can I do about that?
We have to be okay with our today. And I always tell people, it doesn't matter the age, it doesn't matter the financial status. Where you are is where you're supposed to be, and where you're evolving to is where you're supposed to go. So you have to own and be okay with like, okay, yeah, I got myself in this debt because I didn't have the emotional or mental or knowledge to not do it. So now I have it, so I can break the cycle and begin to do something different now. So it's not about where you are, it's about just learning where you're going.
So really what you're saying is, yes, I felt shame for how I got into the situation, but I have to let that go and recognize the fact that I am now taking ownership of that debt and digging my way out of it.
Yes.
What about those people who go past shame and they're depressed about their situation? Would you have them seek professional help?
Oh, yes, definitely. I think even though, I think we need to see therapists in general, just because it's a lifestyle and not just a crisis moment. So I feel like we have to work past our, stigmas about mental wellness and start checking in with the therapist just like you check in with the doctor. Because the depression could be way deeper than your finances when you're letting consume you like that. It could be, I'm caring about what people think, or I'm paranoid about stuff that doesn't exist, or you're overthinking about things that aren't there. So how do I know I move from shame to depression? What are the signs? That's when you start to feel no motivation. Shame, it lasts for moments. You're not in days of it, right? Depression starts to kick in when you're talking about 2 weeks of low motivation, either overeating, undereating. It's hard for you to really physically move to do things that normally you were once motivated to do. You sleep a lot. You're very emotional. I would say those are the quick signs, and you feel hopeless. It's like no hope ever.
And it's not, or you have the bill collectors call and you're avoiding the bill collectors. That's not paranoia, that's reality. Can you give me some examples of what paranoia would look like?
When you think like sometimes, and I don't want to take this where people take it and take it out of context, but where you can be paranoid of thinking like, oh, they're looking at me because they know I have debt, or you're projecting your insecurities onto other people. And that's a part of being paranoid, that people know something that they don't even have knowledge of. And it's not that you're delusional or anything, it's your insecurity being highlighted within yourself.
And for those people who are not yet ready to do therapy, what are some recommendations?
There are a lot of self-help books, journals. There are a lot of workshops, tools, and there's a lot of different experiences through therapeutic experience that you don't necessarily have to go to therapy, but I still would say go to a workshop, get some education, whether you're going to banks, institutions are always offering workshops about finances. There's always workshops on Instagram, Facebook, whatever, social media that are free because I don't want you to create more debt trying to pay for something you can't pay for.
So I want to lean into a little bit about therapy a little bit more because I am concerned about people who are really depressed about debt because it's debt. And, to feel like you're, that you're going to harm yourself because of that is really frightening to me. So I kind of want to lean into that and explore that a little bit more. So there is therapy one-on-one, but there's also group therapy. Can you expand on that a little bit?
So there are different groups, right? So one-on-one is really digging into components of you. The flip side to groups is if you're not ready for somebody to dig into different components of you, group is a better way because then you kind of deal with surface and mid-level things. Because you may not be comfortable talking about your past traumas or exposures to finances that have created this snowball that's going on.
And then people in debt are concerned about incurring new expenses. Is this something that can be paid by insurance if you have it?
Yes. Oh, yes. There's a lot of, there's a lot of stuff going on right now where some of the insurance companies are connecting with the communities offering free therapy services. So even if you had a copay, for instance, right, there are some therapists who have a sliding scale who will work with you if you have insurance to say, yeah, we're not going to take your, copay, we'll just charge your insurance. But you just have to find the right one to work with.
Okay. And then how do they go about finding therapy?
So if you have insurance, you can go through your insurance. There is a website called Psychology Today that I personally prefer because you can filter everything you want. So you can filter what type of insurance you got, even if you're a cash payer, what race, what language, what expertise, what gender. I think that's, to me, one of the best places to find a therapist.
Okay. These are all great tips. Thank you so much, Tamika.
Hi, I'm Corey Timms, host of In My Own Words. Tune in this Friday at 7:30 p.m. on Channel 19 as we hear the personal journeys of some of Chicago's most influential leaders.
To present this week's Money Matters, we have Ben Juergens in studio. I know we have talked about ways to pay down debt, but we also need to know how to handle working with our creditors in a positive way. Welcome to the show, Ben.
Thanks for having me back, Kimberly.
So we have talked earlier about creditors and paying down debt, but how do you have that uncomfortable conversation when you owe somebody money?
Yeah, I think the biggest difficulty people have is just talking to someone and admitting that they might be going into debt or have debt already. And I think the biggest thing that people need to do is develop a relationship with somebody wherever they bank at, somebody that they trust and can also share what their goals are. And the longer that trust builds up with that banker, I think that they can have those more elusive conversations about debt and really have somebody to help join them on that journey and to be that financial coach to get them where they need to be.
So I always thought if I had this little bitty money, why would a banker talk to me? So even if I have a little bit of money, I can still establish a relationship?
Oh, absolutely. And I think that's where people really feel unaware within the financial institution. It's really about relationships. We don't see a lot of the transactions that we used to back in the day. It is about developing that relationship. And I think for me, it's understanding what my clients' goals are, what their short-term and long-term goals are. So if it is getting out of debt, I want to be able to help them with that because you never know. Eventually, while the dollars may be small in the account, putting them on the right path forward can also turn that into a larger relationship down the road.
I like that. I like that. So what happens if I'm already in debt, and I haven't established a relationship? What should I do?
Yeah, so I think a great opportunity here is to put together a debt schedule. Most people have never really written down what their debt looks like. And whether you're looking at the snowball method or the avalanche, I think laying it out on a piece of paper, and imagine going to talk to your banker and say, hey, I've written down all my debts, here's all my interest rates, here's my minimum payments. For the first time, that would be most people's first glance at seeing what that looks like. Bankers don't ever see this. So we would be honored and happy to work with them and just say, you know, when they tell us this is a goal that they have, that sparks the relationship right there. Then we can sit down and put a plan together specific for them and their future goals.
So what about if I'm ashamed to go to you guys? I'm kind of like scared. What can I do to kind of ease that?
Yeah, I think that is also a very big piece. People are afraid to go into a financial institution. For many, maybe their family members in the past had a bad relationship with the bank, or they just feel guilty for the spot that they're in right now financially. But it's kind of like those New Year's resolutions, right? I always feel guilty when I start at the beginning of the year. Maybe I don't want to go in because I'm afraid I'm going to get looked at differently. But we're never going to get to the goals that we want down the road if we never take that first step. And I think that's the biggest piece, is when people come in the bank and they get to talk to someone, that relationship starts to cultivate, and the more that they meet with them, the more comfortable they're going to be in that environment.
Okay, these are great tips. Thank you so much for joining us in the living room today, Ben.
Thank you for having me, Kimberly.
Hi, I'm Tawana Streeter, host of DIY DEI. Tune in on Mondays at 7:30 p.m. as I discuss diversity, equity, and inclusion in the workplace.
Just because our time is up doesn't mean you should stop having these conversations at home with your family and friends, which is my challenge to you this week. Not only focus on the dollars and cents, but how debt may mentally be impacting you. Remember, financial freedom is within your reach, and taking control of your finances is the first step towards achieving your goals. It may not always be easy or feel good, but with dedication and hard work, as well as the right support system, you can overcome any financial obstacle, including getting rid of debt. Make sure to prioritize your debts and create a solid plan to pay them off, while also setting aside some money for unexpected expenses so that you don't fall back into a bad situation. Start small by tracking your expenses, cutting back on unnecessary purchases, and creating a 50-30-20 budget that works for you. For a refresher on the 50-30-20 budget, go to cantv.org in the Money Archives for our budgeting episode. Thank you for tuning in, and I hope that you've gained some valuable insights and tips to help you on your journey to financial stability and freedom. Thank you for allowing me to be on this journey with you.